Welcome back to The Explainer. Today, we're digging into an absolutely wild two-week rally we just saw in the stock market. And more importantly, we're going to see how a very specific group of AI stocks held up during this incredible surge.
Okay, so let's just jump right in. Between March 30th and April 14th of 2026, the S&P 500 just exploded, rocketing up by nearly 10%. Now, think about that for a second. That's more than the market often returns in a whole year, and it all happened in just 15 days. Truly incredible.
So that leads to the big question, right? What on earth just happened? What poured so much fuel on the market so fast? A move this sharp, this aggressive, it's never random. It's always a powerful reaction to something big shifting under the surface.
So here's how we're going to break it all down. First, we'll talk about this big picture idea of a relief rally. Then we'll unpack the key things that drove this move. After that, we'll see how our AI stocks did against the market. And then we'll ask, is a breather coming? And finally, we're going to look at what history says might be next.
Right, so the most important thing to get is that this wasn't just some normal rally. It was a relief rally. And what that means is the market wasn't just reacting to good news. It was more like a rapid unwinding of fear. All this anxiety that had been pushing stock prices down just vanished almost overnight. Now, this is where it gets really interesting. This whole surge was basically powered by a perfect storm of three huge macroeconomic catalysts, and they all hit at the exact same time. It really created the ideal conditions for a major breakout.
Okay, so first up, you had tentative peace talks between the US and Iran. That took a ton of geopolitical risk off the table. Then, number two, a really soft inflation report came out, which basically gave the Fed the green light to chill out on interest rates. And third, to top it all off, analysts started upgrading their profit forecasts. We're talking over 12% growth, which put a really strong foundation under the whole rally.
So the whole market is soaring by almost 10%, which is awesome. But how did our hand-picked basket of AI stocks, our AI fortress, actually do? I mean, did they just tag along for the ride, or was it a different story?
Well, they didn't just keep pace. They absolutely crushed it. The AI Fortress delivered an average gain of over 17%. That's almost double the S&P 500. So this portfolio wasn't just participating in the rally, it was like a massive amplifier.
And this chart just tells the whole story, doesn't it? I mean, look at these individual performances. You see these massive 20–30% gains from the hardware guys and the mega-cap tech giants. Microsoft basically mirrored the market, which is fine. But then you see that one name at the bottom which tells its own really important story.
And this really gets to the heart of what was going on. As all those big-picture fears started to fade, the big money, the institutional capital, didn't just tiptoe back into stocks. No way. It came flooding right back into the foundational hardware of the whole AI build-out. And that's what made these two chip giants the absolute engines of our outperformance.
So this really highlights a super important theme, a rotation within the tech sector itself. While money was gushing into the hardware and infrastructure companies, some of the enterprise software names, like ServiceNow, really took it on the chin. It shows you there's a real fear in the market that AI might actually disrupt the business models of some of these traditional software companies.
Okay, so after a complete melt-up like this, the index jumps 10% and key stocks are up 30% in 2 weeks. The question everyone's asking is, can this possibly keep going? I mean, really?
Well, markets almost never move in a straight line. After a huge surge like that, a period of what we call consolidation isn't just possible, it's actually healthy. It's where stocks basically just trade sideways for a while. They're taking a breather, digesting those huge gains before getting ready for the next big move.
So what does that breather look like? Well, as it turns out, history, and specifically the data from midterm election years, gives us a surprisingly clear roadmap for what might be coming next. See, we're in 2026, which is a classic US midterm election year. And if you look back at decades of data, you see this very distinct cycle play out again and again. You get a spring and summer lull from about April to October, where the market just kind of struggles. Then volatility picks up as you get closer to the November elections. And then finally, you get the post-election breakout, where the market historically takes off once all that political uncertainty is gone.
So, what's the bottom line here? Well, after this incredible historic run, all the data seems to suggest that the market is probably due for a rest. The biggest risk right now might not be some new crisis, but just simple exhaustion. We'll definitely be watching to see if this old midterm pattern holds true. Hey, if you found this breakdown helpful, do us a huge favor and hit that like button and subscribe to help the channel grow. Thanks so much for watching.